Welcome back to Investing Talk Podcast.
Today we're looking at Australian Oilseeds Holdings, ticker COOT. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Yeah.
We have seen, intense focus on Australian Oilseeds Holdings lately. What's been the primary driver of all this interest?
Well, the story here is just pure explosive momentum. I mean, the numbers are kind of breathtaking.
Yeah.
We're talking about a stock that surged over 300%. Just in October 2025 alone.
300%. Wow.
Yeah, it rocketed from lows around, $0.45 up to highs of $4.50 recently. This isn't some slow climb. It's just gone vertical.
Okay. And technically, do the charts back that up?
Oh, absolutely. That huge bullish strength is completely validated by the basic indicators. The stock's trading above every single major moving average.
All of them. 10, 20, 50-day.
Yep, the 10, 20, 50, 100, and the 200-day averages. So when you see that kind of pattern, it naturally gets you that strong buy rating from momentum indicators.
Okay, that surge is electrifying. But we have to throw some serious cold water on that technical picture, right?
Oh, we think so. Why?
Well, while the trend is undeniably up, the intensity is almost frightening. We really have to caution investors here. That relative strength index, the 14-day RSI, it's currently way up at 90.02.
90.02?
Yeah.
Okay. Yeah, that's high.
High. I mean, for anyone who hasn't looked at an RSI chart in a while, 70 is usually considered overbought.
Right.
90.02 isn't just overbought. It strongly suggests the stock's running on, pure oxygen and adrenaline right now.
So a pullback could be coming.
It means a short-term correction, maybe even a sharp one, is statistically pretty likely, irrespective of the fundamentals underneath. The volatility is just extremely high.
Making it more for active traders.
Exactly. This stock right now favors active, tactical momentum traders, not really the passive investor looking for a quiet place to park their capital.
Okay, so if we accept the technicals show massive short-term risk, what actually fueled this 300% jump? It wasn't just charts, right?
No, definitely not. It followed two really critical pieces of corporate news back in October. These seemed to fundamentally change how the market saw the company.
Right. What were they?
First, the company successfully transferred its main listing over to the Nasdaq capital market.
The Nasdaq listing. That sounds technical, but the impact, it's huge, isn't it?
It really is. It's not just about meeting compliance rules. It immediately improves their visibility. And crucially, it gives them access to, deep pools of U.S. institutional capital.
Hedge funds, pension funds?
Exactly. Major asset managers who maybe couldn't buy the stock before. It's a massive step up in liquidity and, status.
Okay, that's one catalyst. What was the second?
The second one speaks directly to the business itself. They announced a major joint venture with Rajashri Foods.
Rajashri Foods. Where's that focus?
Specifically on distribution expansion into India.
Into India. Okay, that makes sense. That move into Asia feels key.
It really shows why the market's suddenly paying such close attention. India is one of the fastest growing edible oils markets anywhere in the world. Driven
by demographics, right? Young population, more health conscious.
Exactly. A massive, young, and increasingly health-focused population. And this deal, it seems like the payoff for groundwork the company was already doing back in August and September.
For their GEO brand?
Yeah, for the GEO brand launch across other high-growth Asian platforms like China. They aren't just, selling basic seeds. They're trying to build a premium global brand.
So there's substance behind the hype.
And that market optimism, while it's intense, it does seem rooted in some genuinely strong fundamental performance too. If you look at the financials, revenue growth has been pretty robust.
How robust?
Fiscal year 2025 revenue hit AU $41.70 million. That's up 23.65% year over year from 2024.
23%. That's solid double-digit growth, especially in a sector that can be pretty mature.
Exactly. And maybe even more compelling, particularly if you're looking for a turnaround story, is the operational improvement.
Yeah. The bottom line.
Yeah, their net losses didn't just shrink a bit. They narrowed sharply, down a staggering 94.33% to negative 1.23 million AUD in 2025.
Wow. Okay. 94% reduction in losses.
Right. So that trajectory, you've got a 23% jump in the top line while almost wiping out the bottom line deficit.
Yeah.
It really shows management is executing a meaningful pivot. They're moving towards profitability.
And there's the whole sustainable angle too, right? That focus seems important.
Definitely. We should touch on that structural competitive advantage. The company's core model focusing on sustainable, non-GMO edible oils using ag biotech innovations, that's not just a fleeting trend, it feels like a durable advantage.
Cool.
Well, the market for sustainable and certified food products, it generally commands a premium price. And getting those necessary certifications, for non-GMO ethical sourcing, it actually creates quite a high barrier for competitors to enter.
Makes it harder for others to just jump in.
Right. It lets Australian Oilseeds holdings demand better pricing and ensures their brand positioning stays strong, especially in markets that are getting more health conscious and, frankly, more regulated globally.
So they're not just competing on bulk commodity prices.
No, they're competing on quality, on ethics.
Okay, that all sounds pretty positive, but this is where we need to apply some critical thinking, right? Override the enthusiasm a bit.
Precisely. Despite that impressive operational turnaround, you absolutely have to look closely at the balance sheet because there are significant weaknesses there.
Weaknesses that explain why it was trading at 45 cents just a month ago.
Exactly. While revenue is up, profitability, it's still under pressure. Their recent pre-tax margin was still negative 5.1%.
Still in the red, pre-tax.
Yeah. It confirms that cost management is definitely still a work in progress. They haven't quite hit the operational scale they need to consistently generate profit yet.
Okay, that's one issue. What else?
And this leads us to probably the most crucial, immediate, near-term risk. Liquidity.
Cash flow.
The balance sheet shows that working capital is currently negative, exceeding $9.6 million.
Negative working capital. Can you just quickly unpack what that means for listeners?
Sure. Simply put, negative working capital means the company's current liabilities, basically what they owe in the next 12 months, significantly outweigh their current assets. The cash, receivables, stuff they have readily available right now.
So they're short on immediate funds.
They're essentially using tomorrow's money to pay today's bills.
Yep.
It's a massive pressure point.
And the risk there is?
Well, if they can't rapidly improve their cash conversion, turning sales into actual cash faster, they'll likely be forced to either dilute existing shareholders by issuing new stock.
Which hurts the share price.
Right. Or take on expensive high-interest debt to cover those short-term obligations.
Also not great.
Either action could immediately slam the brakes on a momentum run like the one we've seen. And you have to remember, they already carry moderate leverage, reporting AU $15.7 million in debt as of June 2025.
So managing that negative working capital is critical to avoid a cash crunch.
Paramount. Absolutely paramount.
Okay, so moving forward then, the focus shifts entirely to what happens next. There are a few triggers coming up in the next 3 months, right, that could either validate this huge surge or, destroy it.
Exactly. The biggest immediate date is the upcoming Q3 earnings report. Yeah. It's on November 14th, 2025.
November 14th. Okay, that's critical.
Absolutely critical. It's the first time we'll get a glimpse of the financial impacts, even if they're minor initially, of those new Asia market ventures.
The India and China stuff.
Right. The initial preparations. If they miss expectations on revenue, or maybe worse, if they show that working capital situation deteriorating further,
then that RSI of 90 is going to correct hard.
You can expect it to correct, potentially violently.
Okay, so earnings are huge. What else is on the calendar?
Beyond earnings, there are other things to watch. In early December 2025, that successful Nasdaq compliance might lead to inclusion in major exchange-traded funds, ETFs.
During their rebalancing.
Yeah, usually around December 1st. ETF inclusion basically means forced institutional buying.
Because the ETFs tracking that index have to buy it.
Exactly. That would provide a huge boost to stability and ongoing liquidity for the stock.
Okay, that's December. Anything further out?
Then looking into the new year, around January 20th, 2026, we'll see the disclosure date for notified institutional buys.
So finding out who bought in.
Pretty much. That's where we find out if the big fund managers used October and November to build up positions. If institutions bought heavily, that provides the kind of validation needed to maybe move the stock beyond this highly speculative retail phase.
Right. And speaking of speculation, we can't ignore the rumors, can we? They're definitely driving volume and sentiment right now.
Absolutely not. Your sources mentioned quite a bit of chatter about two significant possibilities.
Okay, what are they?
First, there are these unconfirmed rumors, stress unconfirmed, about a potential strategic partnership with a major U.S. distributor.
Ooh, that would be big. Unlocking the North American market.
That would be the key, potentially, to finally cracking the massive North American retail market for their GEO brand. Especially given the focus on sustainability, it could be transformative.
Okay, that's one rumor. The second,
Second, the market's buzzing about potential acquisition interest.
a takeover.
Chatter that maybe a global agri-conglomerate might be interested in snapping up the company. Specifically, perhaps, for those unique Asia-Pacific distribution channels they've just set up.
Interesting, but purely speculative at this point.
Vital to stress that. These remain purely speculative. But, in a highly volatile, technically overbought stock like this, these rumors provide the emotional fuel. They keep the bullish retail story alive and keep that volume elevated.
So, looking past the immediate noise, the rumors, the next few months, what about the long-term picture, if they pull it off?
Well, the long-term outlook models, if they execute on getting profitable and manage that debt, they suggest the structural growth story is really compelling.
Driven by the sustainable food trend.
Exactly, driven by that multi-decade trend. Some forecasts suggest significant upside, potentially reaching figures like $6.93 by 2030 and stretching way out to a highly speculative $22 by 2040.
Okay, big numbers, but way down the road and dependent on execution.
Very much so.
So let's try and consolidate this. If you're looking at this stock, you have to see the central conflict, right?
Absolutely. On the one hand, the positive side, you've got this rare combination. Structural tailwinds from sustainable food, proven revenue growth, that 23.65% jump, and that near total elimination of losses, the 94% reduction.
Pretty compelling stuff.
But the clear immediate dangers are immense. The primary downside risks: number one, extremely high volatility. Number two, the stock is severely overbought technically. And crucially, number three, that major short-term liquidity risk from the negative working capital.
And any bad news, especially in that November 14th earnings report.
Could trigger a sharp, painful pullback, no question.
So the overall analysis from the sources suggests it's a high-stakes play. Bullish potential, but high risk.
Yeah, it earns a very bullish rating based on that structural potential and the recent turnaround. It seems attractive for potentially two types of investors.
Ooh.
Short-term momentum traders, maybe trying to capitalize on those immediate catalysts, earnings, partnerships, rumors, ETF inclusion, and also maybe long-term investors looking to capture that structural growth in sustainable agri-foods, willing to ride out the bumps.
Okay, so wrapping up then, Australian Oilseeds Holdings presents this, well, rare and compelling case. Management seems to be improving operations, capturing growth.
They demonstrably are. However, that negative working capital situation means their execution on achieving consistent profitability and positive cash conversion is absolutely critical. They have to nail it to justify this 300% valuation increase. The market's betting big on their success right now, but honestly, that bet is kind of backed by borrowed time. The real question you need to answer before making any move is, which time frame matters most to you? Is it the short-term catalyst window of the next 3 months, or is it that multi-year structural trend?